All right, welcome to episode 9 of Distress Deals Decoded, where real estate problems meet real solutions, brought to you by our friends at Asset Resolution Advisors. Today, we're going to dive into another issue about the emerging opportunities for real estate investors and real estate agents. Our topic today, the Wall Street ban. What happens if the big investors are blocked from buying homes? What if tomorrow Wall Street was banned from buying single family homes? Would the prices crash? Would rents explode? Or would a brand new opportunity class be born? Today, we're going to pull back the curtains on the political proposal that could reshape the real estate investing. Whether it passes or not, we shall see. Okay, so welcome to Distress Deals Decoded. We have real estate problems, and we meet those solutions through asset resolution advisors and all of our experience. My name is Juan Nicasio, along with my partners here, Patrick Butler and Steve Schiller with Asset Resolution Advisors. And today we're going to be decoding the most disruptive housing proposal this year. So, Steve, what is it that is being proposed, and why does this even matter?
Thanks, Juan. So the question of the day or the week, and it's been popular in the real estate industry, is President Trump is trying to add new legislation to say the big real estate investors can no longer invest in single family homes.
Mm.
The reason I think it's being discussed is there's a perception that the investors are making homes unaffordable and that there's a lot of public outrage to Wall Street and what's going on and housing affordability. And so all of this is being pointed to one particular group, and that's the single family investors, the big investors. This matters because for a lot of reasons. First, what I'll say on average for most of our listeners, the local, real estate investors and real estate agents, this is not going to matter. Just the truth. It's noise. It's something that most likely isn't something for anybody to really be concerned about in the big picture of things because investors are not buying up that many properties. However, will it create issues in local areas? Absolutely. Like one of the things I was thinking about as we were going through this is bring a little science into it, right? Newton's third law. For every action, there is a equal and opposite reaction. This is the same type of thing, right? Right now, what we see investors do is they pay near the top of the market. So yes, they make some of the pricing higher, but you know what? A lot of the mortgage servicers, the creditors,
Mhm.
that's what they want. They want to be at the top of the market. They want their money back. So it's not a bad thing. It's just part of the ecosystem that we have. I don't really think it causes high property values. Property values are property values, right? At the end of the day, the big investors are not going to overpay for properties. Did they in 08 and 09? Yes, they did. They did. But we're in a different market. So, it's not really a single problem that we're going to have here. I think what happens if this does happen is we're going to see a few things. One, prices are going to come down a little bit. We're going to see real estate tax issues, right? Because they're paying lower. We saw a big problem back in 08 and 09 for that. It will bring some affordability, but it's not this massive wave of affordability. I think we're going to end up with more upside down properties
Yes.
because of the decreasing in value. There are going to be less rentals, which will be an issue for people who want to live in single family homes as a rental. It'll be probably great for commercial real estate. So again, I think it's all of these that you're going to just see some reaction to this if they do happen to exit. I think for the most of us in this industry and working on real estate, I really don't think that we're going to have a lot of issues to deal with. But as we'll say a little bit later, I think there could be some opportunities out of it.
Mm. I am. So, Patrick, on your side, like, what is your take on all of this? Like, if it does happen, what do you feel would be either drastic or minor changes in the landscape?
To me, there are a couple of things. One of them is there are two sayings that I've always heard and said throughout my life. One of them is be careful what you wish for, right?
Mm,
When we heard of the big institutional guys coming out buying up single family homes, there was definitely the sky is falling mentality, right? People were like, oh my gosh, they're going to kill our entire marketplace. We as smaller investors won't be able to compete with them because they are paying top dollar for these homes in many cases. And
mhm,
Steve, to your point, that was back in 2008, 2009. These big institutional investors are really were only buying a small fraction of the available inventory. For
right.
some markets, they were much more aggressive than others. So if the ban, in fact, occurs, those markets that may have been affected, at least perception wise, which was saying number two, that perception is reality, that may make a little bit of a superheated marketplace in those areas. But again, supply and demand, right? So where there is inventory, there will be buyers. And what we're witnessing right now, institutional buyers or not, is a beginning to explode, for lack of a better word, default real estate situation. So
Mhm.
for homeowners that have the appetite to buy properties, maybe using a rehab loan, for investors that want to become wholesalers, for fix and flip investors, or for the BRRRR investors, the buy, rehab,
Yes,
rent, refinance guys, there will be more opportunities for them. So I believe that there's going to be an upside to that thing, right? All of the reasons why they couldn't do it will be gone if this does not occur. Secondly, the rental market consequences. Steve, you mentioned that. What I was envisioning when these big institutional guys were coming in is that they were going to buy up as much as they possibly could and just
hmm,
create a nation of renters. But that was not, in fact, the case. That did not happen. So again, for investors that are buy and hold folks, there should be more inventory, however much that is. So it gives them an opportunity to come into the marketplace. Steve, you talked about maybe rental prices being affected. Yeah, I mean, renters though are renters, right? So whether an investor on an institutional level is buying the properties or a mom and pop investor, the renter still needs to rent. So there may be a play there with what does it do to rental prices in the marketplace. The distressed deal explosion, though, let's talk about that again. This is a huge opportunity. If, in fact, there's a ban on institutional buyers, and if, in fact, there is an explosion of distressed real estate, which there is, then this creates a huge opportunity for the folks that we deal with on a regular basis, the real estate
hmm,
professionals, investors, agents, title companies, everybody else, to sink their teeth into a piece of the marketplace that continues to cycle. Every generation or so, we see one of these. There was a savings and loan crisis, we had the Great Recession, and here we are again with another situation post COVID. So I think it just creates opportunity here. Again, whichever side of the coin you think is real, you're right. Whether you think you can or you think you can't, which I think was a Henry Fordism. So that's my third saying. You're right, and so it really becomes a product, Juan, in my personal opinion, of being knowledgeable about both sides of the coin, being
sure.
prepared to pivot if need be for your own personal business. But as long as you're prepared, you're going to be okay in this business. Back to you in the
Well,
studio.
and
Oh,
if
yeah.
I could add one thing, if I could add one thing to that, Patrick, which is great, right? Which is exactly what President Trump said, right? Is both sides are true. And what happened was on one side, it's like, hey, let's get these investors out, right? Let's make this more affordable. Let's bring down prices. Let's do all that. At the same time, he then said, oh, and I'm telling Fannie and Freddie to go buy a bunch of bonds so we can lower interest rates. Okay, great. What happens when you lower interest rates? More people are buying. Guess what happens to prices?
They
They
go
go
up.
up. So
Yep.
the
Yeah.
affordability you're probably creating on one side is just going to be killed on the other side.
It's like
So
remember those long balloons we used to blow up as kids and you'd make animals out of them? It's like stepping on one end of that. No matter where you step, it goes up in other parts, right? And unless you
Yeah.
smash the whole thing and it
And
pops, but otherwise it's
yeah.
just a matter of parrying and pivoting.
And that's I share the same views as you guys. And that's literally how I see it. The the prices that we're dealing with right now had nothing to do with institutional investors. They were a very, very small party of buying properties. But like you said, Steve, They didn't overpay for property. When we had the iBuyers, right, and the institutional hedge funds buying property, their math is buying at 80 to 90% of value. So a small margin, yes, from the actual appraised value of the home, but it wasn't overpriced. You know who overpaid for property? The consumer, the normal homeowner. They would buy the property for list or over list price. So is it the institutional investors that are a problem? Absolutely not. And I feel that, as of, I would say 2023, like mid 2023, as the interest rates really hiked, the institutional investors, they are on the sidelines. They haven't been buying
Yeah.
as much, right? And so that is not a problem. I think that is a bunch of noise. Now it will cause, for institutional investors to just be very, very cautious with their capital. I feel that in order for there to be affordability and for these investors to actually come back to the market very aggressively, something major has to happen, right? Like something needs to be really pressed down, like a 2008, which I really don't see happening. But we would need something like that for affordability to happen. And then like a happy medium in the interest rate so that it's somewhat affordable, both in pricing and then on the side of the interest rates, which obviously predicts what people can afford on a monthly basis. I know that lending is going to be tightened for rental portfolios, which is going to affect, insurances, HOA, code enforcement, property tax pressure may rise as well. So, it would be interesting to see how this all plays out. I just feel it's a bunch of noise, something that is not causing any real effect to the normal consumer or the normal homeowner. Inflation is the problem. It isn't institutional lenders, right? But even with nothing happening, I think that underwriting's already changed. Okay, we're seeing a lot more distress. These distress and compliance, burden properties are growing, which makes a perfect storm for short sales, probate, inherited, rentals, HOA liens, and bankruptcy exits as well. So again, these times are a bit, in the how do I say it? Just kind of like we're going with the waves, right? We're going with the motions. We don't know if we're up or if we're down. We just kind of have to ride that current wave and see exactly how this plays out. That things are going to change. Yes. Is it going to be a drastic change? Absolutely not. I don't see that. Now, Steve, why is this, distress timeline a like property gold rush? What do you see that can be emerging in this new market?
Yeah, like I said, opportunity, opportunity, opportunity here. From an agent's perspective, I think there are a lot of things out of this that we learn,
Mhm.
right? Number one is we're gonna, with the current administration, and it's not just this, it's not Republican, Democrat, all administrations, this happens, right?
Okay.
There's fluctuations. And I think that it's great for agents and real estate investors to adapt, right? And to change. So from a real estate agent, learn distressed assets. That doesn't mean it's only default, doesn't mean it's only short sale. It can mean any of the things you just said, Juan, right? There's probate, there's heirs, there's HOA, there's all types of different things that are really important for people to learn about. So I think for agents, learn distress. There's going to be more of it, and it's really important to understand how to best accomplish getting those deals and then getting them sold. There is going to be a lot of volatility, right? Make sure you're partnering with the right groups, not just us, not just any vendor, any type of real estate investors. It's very, very important for agents to do that. And then also, for agents, it's not just about selling short sales, it's also buying short sales. It's a
Mhm.
skill, right? Understanding the short sale process, understanding the distressed asset process, and getting your buyers and sellers ready for it gives you a huge advantage into the market, and it shouldn't be scared of it, right? It's out there. From an investor standpoint, I think this is also really important, right? So be flexible in your strategy. So one of the things, Juan, we talked about, Patrick, we talked about, and I think what we're seeing is this transition right now for real estate investors is this got so used to doing, oh, I do wholesale. I do wholesale innovation. Oh, I do fix and flip. Well, you might have to do a little bit of all of them just to make the deals, because each of the deals have its unique character. You're going to find some deals that are fix and flips, some that are going to be rehab and rentals, and some that are going to be who knows what, just a flat out sale. So I think from an investor standpoint, really important to start educating themselves on distressed assets and what your various exits are. I think that there are going to be a lot of advantages for real estate investors in this market. A lot of niches that they're going to be able to get in and acquire properties, maybe a little bit lower than market value because there's not as much competition. But I think the most important thing is fix and flip. I'm sorry, most important thing is having diversity, fix and flip and whatnot. Wholesale innovation, I think those are headed towards very difficult times in the coming market. I think it's going to be really hard with pricing coming down. There's some legislation coming down. So I think between all of it, it's just going to be much more competitive. And so I think for real estate investors, getting into those other areas is important. And you know what? Learn from the big investment companies. Learn. You know what they did? They do various things. And you know what? They have tighter margins, but they do a lot of it. And they figured out a way to diversify their portfolio, right? So they're doing rentals. They've securitized loans, right? So they're doing all sorts of different things to make their income and revenue stream. We should learn from that and say, yes, we need to do the same.
Can I enlighten you guys a little bit? I feel that the non-hedge fund institutional Wall Street investor, they're going to do so much better in this market than the actual Wall Street investors. Why? The Wall Street investors, they don't buy a property that doesn't have clear marketable title. Their buy box is very, very specific. They're not going to go buy a 1957 3-bedroom, 2-bathroom that was conformed into something else or has liens and violations and things of that nature. So again, I don't think that their impact in the market is going to matter now, and or if these things do come to pass, which I don't believe so. I think the money is in these investors that can navigate through what we do help our real estate agents and investors with, is understanding these niches, which is the biggest demand that we're going to have. Again, there are a lot of people that are going to be upside down. There is no institutional investor that's going to go buy, a short sale unless they're buying the block, right? They would probably have to be more so closer to a foreclosure than a short sale. I don't think they're going to play in that world. So there is going to be a ginormous opportunity for real estate agents and investors to jump into these type of niches before obviously things hit the fan. Does that make sense, guys? Right? Yeah. And so, Patrick, how would you, position, smart agents and investors to navigate through these processes, through these
So I think we can pull all of these strings together. So one of them, the great Floyd Wickman of Sweat Hogs fame, he always used to say, use the news. And it was funny because, and Steve, you and I talked about this. There was a point in time when interest rates came down to 5%. And everybody's like, oh, thank God, rates are so low. This is amazing. And then in recent times, rates went up to 5%. Everybody's freaking out that rates are so high. Well, whether you think you can or you think you can't, you're right. And in this case, the rate was the rate. So there's always opportunity for a real estate professional, whether you're, let's just call it a real estate marketer, looking for transactions, whether you're a real estate agent, real estate investor, using the news, which sparks people's attention. All of a sudden, they're wary of something. Oh my gosh, something's about to happen. The sky is going to fall. Great opportunity to start your marketing campaign and leverage the news. Whether it happens or it doesn't, it's one of those things that they always say, any press is good press, even bad press, right? And so using that is number one. Number two, unless you are buying nationwide and that is your entire marketplace, kind of what we talked about, none of this really matters because, specifically if you're a first time home buyer, you only need one house. It doesn't matter what's happening nationally, as long as in the area that you want to buy a house, there is one and you can afford it, problem solved. But more importantly, as investors and as real estate professionals, understand your micro market. What would this or won't this do to your local marketplace? So if you're living in Omaha, Nebraska, there may be a different impact if this ban does occur compared to those living in Southern California. And I just picked those two cities at random, but be aware of what's happening in your marketplace because that's really all that matters to you. And then number three is assemble a team. Steve, you mentioned it. I believe in this wholeheartedly because you can't be all things to all people. And they say if you try and be everything to everyone, you'll be nothing to anybody. So, whatever your personal niche is, if you're a wholesaler, I say to Steve, your point, stick with that until it's no longer viable, but bring in a fix and flipper. Bring in a
Mhm,
real estate person. Bring in a good title company who still needs us, by the
mhm.
way, because they hate cleansing title on
Yeah.
these deals. But make sure you've got your team ready to go because when and if it does happen, you're poised and you're there.
Mhm.
Lastly, real estate agents, investors, I believe that there's a great time in the marketplace now because of technology to leverage that, educate the consumers, right? The days of the investor going in and swindling somebody out of their house, the poor old lady that's going into foreclosure, not only is that bad karma, it's not the right thing to do. And there are much
Right.
better ways to make a lot of money in this business. So educate your marketplace. You'll gain more notoriety. You'll be perceived as that expert and build trust and build all of those
Mhm.
things that you need to be able to transact those transactions. So I believe that's critically important. In uncertainty, specialists will always win the race. Back to you, Juan.
Oh, agreed, 1000%, man. I think that the days of, being a sleazy salesperson, that just doesn't work. And education and building trust, being more likable is going to get you so much further, man. So I appreciate that input that you put that out there for the listeners because man, they are going to be absolutely, crushing it in the next 5 years. So whether this ban happens or not, distress inventory is absolutely rising. We see it every single day by the boatload. And the agents who can solve these deals will own the next 5 years. Thus, why we built this our school community where you can come and learn how to navigate through these different niches, through these different complex distress properties, be able to not only help yourself but help the homeowner and all parties involved to move deals forward. Also, a place where you can get certification on short sales and bankruptcies. You can submit your deal for review so that you're not navigating through these distressed assets all on your own, and also outsourcing options, right? We're here to say, hey, look, these things are very, very complicated. This is not something I really want to navigate through. Would you guys, kind of partner up with us on these type of deals? Absolutely, you have that option. So whether you try to figure this market out on yourself, on your own, or you want to plug into a team, just be ready to solve these files daily, right? Wall Street doesn't make markets, problem solvers make markets. And the bigger the disruption, the bigger the opportunity. Please, guys, if you enjoyed this episode, I would encourage you to please like, subscribe, comment, and share this particular podcast here, this YouTube video that we've filmed for you here. And also, subscribe to our school community where, again, you can come in and learn about how to decode these distress deals. My name is Juan Nicasio, along with my partners Patrick and Steve. Thank you so much for joining us here live on this YouTube episode. Till the next one. See you guys soon.
Bye, everybody.